Are you ready to level up your money moves in Canada? Let's talk ETFs, that's exchange-traded funds, your ticket to investing smart, without needing to pick individual stocks and with big benefits on your side. An ETF is essentially a basket of assets, stocks, bonds, commodities that trades on an exchange just like a stock. Why does this matter? In simple terms, ETFs give you instant diversification, low cost, and liquidity. You can buy and sell anytime. For newcomers or Canadians looking to grow wealth, that's huge. Compared to individual stocks where you carry company risk, what if that one stock tanks? ETF spread risk. Compared to mutual funds, they often come with lower management fees and you can see the price in real time. Also, many brokers allow you to buy with zero commission. Now, let's walk through how you can get started in Canada. First, pick your platform. Top Canadian brokers that support ETF investing include Wealthsimple Trade, Questrade, BMO InvestorLine, TD Direct Investing, and Moomoo Canada. These platforms let you open a tax-advantaged account like a TFSA or an RRSP and then buy ETFs in Canadian dollars or US dollars if you want US-listed ETFs. When you open the account, meet the ID residency requirements. Link your bank account, pick your account type, for example, TFSA, if flexibility matters, and once you're funded, search the ETF ticker and buy it. Many offer commission-free ETF purchases, especially in Canadian dollars. So what should you invest in? That depends on your goals and risk profile. But let's review 5 high-performing ETFs in Canada over the last 5 years. These are past results, not guarantees. According to Trade That Swing, some of the top returns included 1 ZEG, 2 iShares, S&P, TSX Capped Energy Index ETF, approximately 396% 5-year return. 2 ENCC, 2 Global X Canadian Oil and Gas Equity Covered Call ETF, approximately 375-year return. 3 ZEB.2 BMO Equal Weight Banks Index ETF, approximately 155% return. 4 XFN.2 iShares S&P TSX Capped Financials Index ETF, approximately 154% return. 5 Tech.2 TD Global Technology Leaders Index ETF, approximately 146% return. Notice a theme. Many of the top performers were sector-specific: energy, banks, tech. But investing in those comes with higher risk sector swings. That's why for many beginners a broad index ETF might be better: lower cost, greater diversification, smoother ride. Let's pause and look at the benefits of ETFs again. Low cost. Many ETFs have very low management fees compared to traditional funds. Diversification. One ETF can hold dozens or hundreds of securities. Transparency. Holdings are disclosed. You can see what you own. Liquidity and flexibility, bought and sold like stocks during market hours. For newcomers, you can use your TFSA or RRSP to hold ETFs, meaning the tax-advantaged wrappers make the growth even more powerful. Now, a few strategic tips. Decide your goal. Are you investing for just in case, short-term or long-term wealth? That dictates risk posture. Prefer a core plus satellite strategy, a core broad ETF, for example, Canadian index or global index, and maybe a small satellite portion in higher growth sector ETFs, if you accept higher risk. Monitor your platform fees and currency conversion costs. If buying US-listed reinvest dividends if the ETF pays them, compounding matters. Stay consistent. Even small monthly contributions add up over time, thanks to compounding. Don't chase last year's hot sector to aggressively past winners like oil or banking might face headwinds. Before I wrap up, quick watch out: be careful with ultra-niche or leveraged ETFs. They can magnify losses. Make sure your ETF actually trades on a regular market, has sufficient assets and reasonable cost. And always check if your platform supports buying that ETF in your account type, TFSA, RRSP, or normal brokerage. If this video helped you, hit subscribe, smash the like button, and drop a comment with which ETF you're eyeing. I'll highlight subscriber picks in future videos so we can all learn together. Disclaimer: this video is for educational purposes only and does not constitute financial or investment advice. Your personal situation is unique, and investing involves risk. Always consult a qualified financial advisor before making investment decisions.